Somewhere behind every spinning slot animation on a licensed gambling app sits an owner who spent months buried in state-by-state paperwork, background checks, and compliance audits, knowing that a single regulatory misstep could shut the entire operation down overnight. The flashing lights hide a business built almost entirely on managing risk. Online casino gambling is legal in only 7 states across the entire United States: Delaware, New Jersey, Pennsylvania, Michigan, West Virginia, Connecticut, and Rhode Island. Yet in just those 7 states, combined revenue crossed $10 billion last year alone, growing nearly 28% from the year before. And 3 states, Michigan, New Jersey, and Pennsylvania, account for almost 90% of that entire total. Outside those 7 states, online casino games are still technically illegal, which forces the rest of the country into 2 options: driving to a physical casino or using offshore platforms, licensed in places like Curacao, that operate in a legal gray zone the federal government has never fully enforced against. Millions of Americans use these offshore sites every single day, and almost none of that revenue shows up in any official government report. Most players never think about any of that. They just see a slick app, a welcome bonus, and a slot machine spinning on their phone screen at midnight. What they don't see is a business shaped entirely by geography and law, rather than demand, where the same game, the same math, and the same odds can be perfectly legal in one state and functionally banned 300 miles away. This patchwork exists because gambling regulation in America has always been decided state by state, never nationally. When the federal ban on sports betting was struck down in 2018, each state was left to write its own rules from scratch, and most chose to legalize sports betting while leaving online casino games in a legislative gray area that many still haven't touched. Only a handful of states saw the tax revenue potential and pushed casino legislation through, usually after watching a neighboring state collect millions in gambling tax revenue that used to belong entirely to unregulated offshore sites. That hesitation created something unusual: a business where the size of the legal market has almost nothing to do with population. Pennsylvania and New Jersey, both mid-sized states, generate more online casino revenue than California and Texas combined, simply because those larger states, despite having the largest populations in the country, never legalized the product at all. Understanding who profits from this business means first understanding that geography, more than demand, decides who even gets to compete. And every year a new state debates legalization, the entire industry watches closely, because a single new market opening up can be worth more to an operator's bottom line than a decade of growth in an already crowded one. Getting licensed to operate legally in even one of these 7 states is far more expensive than most people assume. Pennsylvania, for example, charges roughly $10 million just for the initial license covering online slots, with separate multi-million-dollar fees required for table games and poker if the operator wants to offer those too. Other states charge less upfront, but require ongoing compliance costs that add up just as fast, including background checks on every executive, technology audits, and proof of financial stability before a single bet is ever accepted. And that license only covers one state. An operator that wants to compete nationally has to repeat this entire process, with different rules, different fees, and different regulators. In every single state where online casino gambling is legal, there is no single national license that covers the whole country, which means the paperwork, legal fees, and waiting periods multiply with every new market an operator tries to enter. Beyond licensing, there's the technology. Every platform needs geolocation software capable of confirming in real time that a player is physically inside the legal state boundary, because a single bet placed from across a state line can trigger regulatory penalties serious enough to threaten the license itself. That geofencing technology has to work flawlessly on every phone, every browser, and every connection type, with zero room for error. And any failure in that system is treated by regulators as a serious violation, rather than a simple technical glitch. Operators also need enough working capital on hand to cover player withdrawals at any moment, since a platform that delays cashing out a winning player, even briefly, can face regulatory complaints serious enough to draw the attention of state gaming commissions. That means holding significant reserves in cash, rather than reinvesting every available dollar into growth, a trade-off that smaller operators often underestimate before entering the business. Then comes the cost that dwarfs almost everything else: marketing. The biggest operators in this industry have historically spent hundreds of millions of dollars a year on advertising, promotional credit, and celebrity endorsements just to acquire new customers. Because in a market with only a handful of competitors fighting over the same limited pool of legal states, whoever spends the most on visibility tends to win the largest share of players. Only after all of this, licensing, technology, compliance, and marketing, does the operator's platform actually start generating revenue from real bets. Revenue in this industry is measured as gross gaming revenue, or GGR, which simply means total bets placed minus total winnings paid out. On online slots specifically, operators typically keep between 25 and 30 cents of every dollar wagered, nearly 3 times the roughly 10-cent hold that sportsbooks keep on sports bets. That difference alone explains why so many operators have pushed hard to expand from sports betting into full online casino products wherever the law allows it. But that 25 to 30% hold is gross, not net, and state taxes take a bite that varies wildly depending on where the bet was placed. Pennsylvania taxes online slot revenue at 54%, one of the highest gambling tax rates in the country, which means operators there can post the largest revenue numbers in the nation while still earning some of the thinnest margins. Michigan and New Jersey, by contrast, tax online casino revenue at a more moderate rate, which is exactly why analysts consider those two states the most profitable markets for operators today, even though Pennsylvania generates more total revenue. After state taxes, the next major cost is promotional spending. New players are typically lured in with bonus credit, free spins, and deposit matches that can equal a significant share of what they eventually wager, and operators fund all of it directly out of gross revenue before a single dollar becomes profit. Add in payment processing fees, customer support staffed around the clock, cybersecurity to prevent fraud and account takeovers, and the technology licensing fees paid to game developers for every slot title on the platform. Most operators also run online casino and sports betting side by side, and the two products feed each other in ways that matter financially. A customer who signs up to bet on football is often nudged toward a slot game during halftime, and casino games generally produce a far higher hold percentage than sports wagers, which is exactly why so many sportsbooks pushed hard to add casino products the moment their state allowed it. There's also a cost most players never think about: responsible gambling compliance. Operators are legally required to fund self-exclusion programs, monitor betting patterns for signs of problem gambling, and in several states, contribute directly to state-run addiction treatment funds. None of that is optional, and all of it comes straight out of the same revenue that looked so large just a few paragraphs ago, long before anyone gets close to calculating an actual profit. And this is exactly where most people get the math wrong. The number left over after every deduction isn't small. It's just very different from what anyone watching from the outside would assume, and it still hasn't been revealed. Before revealing what actually lands in an operator's pocket after all of this, hit like on this video. It's what helps this channel keep investigating the money hiding behind industries most people never stop to question. Take a mid-sized operator, licensed in 2 or 3 states, generating an estimated $40 million a month in gross gaming revenue, a realistic figure for a well-positioned platform, but nowhere near the industry's biggest names. After state taxes that can range from 15 to over 50% depending on the state, promotional spending, technology fees, and compliance costs, analysts who cover the sector estimate a net margin somewhere between 8 and 15% of gross revenue for an operator at that scale. That translates to an estimated net profit between $3 million and $6 million a month. For that hypothetical operator, a meaningful number, but one that comes with important context. Before ever reaching that figure, the owner had to recover millions in licensing fees across every state, the upfront technology build, and years of aggressive promotional spending, a process that industry analysts say commonly takes 2 to 3 years of sustained operation, far longer than most new businesses need to break even. It's worth noting that this is the picture for a mid-sized multi-state operator. The largest public companies in this space spent years posting losses nationally, even while generating billions in revenue, because the cost of acquiring customers in a new state almost always outweighs what that state generates in the first year or two. Only after building a large enough base of returning players across enough legal states did the biggest operators finally turn consistently profitable. Margins also improve with time in a way that has little to do with luck. A platform's first year in any new state is almost always its most expensive, loaded with sign-up bonuses and aggressive advertising meant to grab market share before competitors do. By year 2 or 3, a larger share of revenue comes from loyal, returning players who no longer need bonus credit to keep playing, which is when the real profitability of the business starts to show up on paper. Regulatory risk never fully disappears either. A state can raise its tax rate overnight, as several have already done, once they realized how much revenue was on the table, instantly compressing margins for every operator already active there. And because so few states allow this business at all, the entire industry remains concentrated among a small number of companies large enough to absorb licensing costs across multiple markets simultaneously, leaving little room for smaller operators to ever catch up, no matter how good their odds, their technology, or their customer service might actually be. In the end, the online casino industry hides a lesson that goes far beyond the 25 to 30% hold operators keep on every dollar wagered.